We're going to talk about market organization and structure. This particular topic review, it introduces a lot of terminology and a lot of securities and types of securities that we really cover in more detail elsewhere. So some of it we won't go into in too much depth, but I want to cover all the definitions and introduce the terms so we know what those are, and then we'll pay special attention to types of orders and margin transactions, short sales, and a couple of calculations. So let's jump into that and first talk about the overall functioning of the financial system. Let's just go through these bullet points here. Allow entities to borrow, save, issue equity, manage risk, exchange assets, and utilize information. So I think that's pretty straightforward there. The financial system also determines the returns that equate savings and borrowing across the economy. So that's similar to what we talked about in macroeconomics. We've got borrowers, we've got savers, and some interest rate, some equilibrium interest rate is determined, and that's all part of this functioning of the financial system. And our third point here is that the financial system helps to allocate capital efficiently. And what we mean by that is to its highest valued use. So by the pricing of securities, the rates of returns, adjusted for risk and things like this, hopefully capital is flowing to its most productive uses in the economy. Let's see, we've got here an investor expects to earn an equilibrium fair return over time, and we want to differentiate that from an information trader who expects to earn a positive risk-adjusted return. So an information trader is trying to identify mispriced securities, whereas an investor expects just to earn the equilibrium returns over time. And we want to define a hedger as a person or an entity that's taking on a position to offset an existing risk. So if you're Starbucks and you need to buy a lot of coffee beans, you might want to hedge your coffee bean price risk. And various businesses have various risks inherent to their businesses. And one thing the financial system does, and especially with regard to some derivatives contracts, is facilitate the transfer of risk from those who have it to those who are better able to bear it. And so that's an important function as well. We need some terminology for the classifications of assets. We've got financial versus real assets. Well, real assets are physical assets like machinery and trucks and locomotives and factories and things like this, whereas financial assets are, well, they used to be pieces of paper, but they're not even that anymore, are they? They're just electronic entries somewhere. So our bonds and stocks and preferred stocks and certificates of deposit and all that are classified as financial assets. We can differentiate between debt and equity securities, between bonds and stocks, although there's a little overlap, and we have some hybrid securities that have some of the characteristics of both. Public versus private securities. When we talk about public securities, we're talking about securities that are registered with the regulators for sale to the public and trading in public securities markets. Physical derivatives versus financial derivatives. Well, physical derivatives have a physical underlying asset, gold, wheat, copper, things like this, whereas financial derivatives are based on interest rates or bonds or options on equity securities. These are all considered financial derivatives. Classification of markets. When we talk about spot markets, we're talking about the markets for immediate delivery, and the reason this becomes important is when we talk about futures markets, if we're talking about July wheat futures, then we're talking about delivery of wheat in July and the price being the price for July wheat rather than wheat right now. Primary markets versus secondary markets. Basically markets for newly issued securities versus markets for used securities. The primary markets, the proceeds of the offerings go to the issuing company. And in secondary markets, well, that's like stock exchanges or the over-the-counter markets where the purchase of a security, the money goes to the seller of the security and not to the issuing firm. Now, most markets we deal with are continuous markets, and that means that trades are made all during the period during which the markets are open. With call markets, buy and sell orders are accumulated for a period of time, and then a price is determined that approximates the equilibrium price, which balances out supply and demand, as evidenced by the accumulated orders, including any limit orders that are in. The opening rotation of the New York Stock Exchange is similar to a call market because orders have accumulated while the market is closed, and the specialists at the beginning of the day try to open those stocks at prices at which supply and demand are at least initially in balance for the start of the day. But the New York Stock Exchange is we would refer to as a continuous market. Money markets versus capital markets, that's just a time dimension. When we talk about money market securities, we're talking about securities that mature in a year or less. And certainly we're talking about debt securities there, since most of our equity securities don't have maturity dates. So capital markets just refer to the markets for securities that mature in more than a year or don't mature. Traditional markets versus alternative investments, well, we've got a study session called Alternative Investments, so that'll be described there, but it includes such things as private equity funds and venture capital funds and real estate and what else, so, and mutual funds are talked about in there, whereas traditional markets are the markets for stocks and bonds. Types of assets, well, we know we've got equity securities that represent a residual interest, right? The equity holders or the common stockholders get whatever's left after all the obligations, including debt repayments and interest payments, have been made. When we talk about fixed income securities, often the income's not fixed, but this includes our debt securities. And of course we've got 2 study sessions on that. So pooled investments, we cover that really in alternative investments in the level 1 CFA material. Cover mutual funds and REITs there, real estate investment trusts, which are like mutual funds which hold property instead of securities, real property or mortgages on real property. ETFs, exchange traded funds, similar to mutual funds but a little bit different in their trading. Asset-backed securities, well, we cover that in fixed income securities, but one thing to remember there when we talk about asset-backed securities is that they are backed by financial assets. So we're not talking about collateral, we're not talking about real estate-backed securities or securities backed by pledge of other firm collateral, machinery, locomotives, whatever it might be. Hedge funds we'll talk about in alternative investments as well. Hedge funds used to hedge, and some still do a little bit, but often now hedge funds are just encompasses a whole variety of strategies, and they're not publicly traded, and they are much less regulated. And as we'll see when we take a close look at those in alternative investments, there's some significant problems with bias in the returns data that we get for hedge funds, as opposed to publicly traded securities where, or publicly traded mutual funds where the disclosures are much more, what's the word I'm trying to think of, more requirements for disclosure. Rather than the kind of selective disclosure we run into with hedge funds. Currencies, I guess what we know what those are. We can buy them in the spot market. You can buy euros, or you can buy yen, or you can buy dollars and collect euro interest or yen interest or dollar interest. Contracts, forwards, futures, swaps, options, and insurance. We don't talk too much about insurance at level 1. But forwards, futures, swaps, and options are covered in our study session on derivatives. Commodities, cover that to some extent in the alternative investments study session. And real assets, well, we know what that is. We talked about the difference between real assets and financial assets already. Now let's talk, we're still talking about the overall financial system and its functioning, the organization and structure of markets. So we need to talk about some intermediaries, brokers and exchanges. Well, brokers, remember, are a go-between between buyers and sellers. Think of a real estate broker. He doesn't own all those houses or apartment buildings that he or she is trying to sell, but they are a go-between. Dealers, on the other hand, well, it says here match buyers and sellers of the same security at different points in time. I guess that's one way to say it, but really they buy and sell from their own inventory. So think real estate broker when you're trying to define a broker, and think about a used car dealer when you're thinking about a dealer, because they buy them and they put them on the lot, and then somebody comes and they look at it. So they're facilitating the trade, they're providing liquidity, and that's how they earn their money, based on buying a little lower than they sell, hopefully, or at least on average. When we talk about arbitrageurs, at least in its pure form, riskless arbitrage, we're talking about buying identical buying and selling the identical assets or securities in two different markets. Now, we can kind of relax that and we say, well, there's something we call risk arbitrage too, where it's not a certain transaction. But the idea is making, exploiting the differences in prices between two different markets, or a bundle of securities that has the same payoffs as a single security. If those prices aren't equal, there's a chance for an arbitrageur to go in and buy the lower price security or portfolio and sell the higher price security or portfolio. When we talk about securitizers, we talked about asset-backed securities. Well, the securitizer takes a lot of securities, financial claims, and puts them all together and then sells shares of that pool. So if we're talking about a mortgage-backed security or a Ginnie Mae certificate or something like that, then these are loans that are put into a pool, and then claims against that pool of loans are sold. But we securitize things like credit card receivables and automobile loans and home equity loans and small business administration loans, and there's a lot of things that can be securitized. And within the financial system, this lowers the cost of raising the funds, because they're packaged in such a way that institutions find them attractive. We can do business in large amounts, and this brings down the cost of funding, which is most often the idea. We've got our depository institutions, banks, savings and loans, building associations, whatever they're called, in your country or your jurisdiction, where they take in deposits and then manage a pool of loans, manage the risk of the loans, and to some extent own securities as well. That seems to be what banks are into these days, is borrowing money at 0% and investing it in government securities that pay more. It's a good business while it lasts, huh? Maybe they can get their equity back up to some acceptable levels. Insurance companies, well, they manage a diversified pool of risk. I think we're not going to get too much into that in the Level 1 curriculum. Clearinghouses are important, especially in the derivatives market. The clearinghouse stands between the buyer and the seller, and actually guarantees both sides of the trade. And so by doing this, they reduce what we call counterparty risk, right? If you buy a derivative security, somebody's on the other side and sells that derivative security, the counterparty guarantees the payment to whichever side wins, whichever side has the gains. So that means you can trade in those markets without worrying about the creditworthiness and the overall financial position of the other party to the trade. Just some more definitions here. A long position, well, a long position is pretty easy to define with equities. You say, well, if you buy some shares of stock, you're long. If you sell stock that you don't own, you're short. But we want to generalize that a little bit more and say that a long position gains when asset values increase. So if we buy a call option, which gives you the right to buy a security at a particular time in the future or for a particular period of time at a particular price, well, that call option is going to increase in value when the asset price goes up. On the other hand, put options increase in value since they are the right to sell at a specified price over a particular time period. Put options increase in value when asset prices go down. So if we sell puts, then we have something similar to a long position, because being short puts, the value of your position goes up when asset prices go up. So that's getting a little convoluted there, being short puts to get a long position in the underlying asset. Long futures and forward positions. With a long futures position, that's where we promise to buy in the future, enter into a contract saying that we'll buy in the future at a particular price. Well, clearly that position goes up when future asset prices go up. A short position gains when asset values decrease. So the simplest situation is when we borrow a security that we don't own and sell it, hoping to buy it back in the future at a lower price and realize some gains there. In the options market, when we sell calls, if we're short calls, then we have a short position. But when we're long puts, those puts increase in value when asset prices fall, so that's equivalent to or very similar to having a short position. And a short position in futures and forwards, well, if we promise to deliver the financial asset or the physical asset in the future, then we'll gain when future asset prices fall. So we'll typically call that or refer to that as a short position. Financial leverage happens when we borrow part of the purchase price. We're going to talk later on in this topic review about margin purchases and how we can get leverage purchasing equity securities on margin. But also when there's no borrowing involved, as in the case with a futures or forward contract, we can still have quite a bit of leverage there because we're posting less than the asset values. We post a margin, a deposit with futures contracts that just covers a few days of potential losses, and if the position goes against us and we have losses, then we need to put more money in. But the idea is you're putting up only a fraction of the value of the whole contract value of 500 ounces of gold or so much interest in the S&P 500 index or whatever that futures contract covers. So let's get into some of the details of short selling here. Short selling is great for the markets. You hear bad things about it and bad things about evil short sellers, but you know, it's like saying you're having an election but you can only vote one way. Okay? With short selling, you can vote that you think a stock is overvalued in the marketplace. So to the extent that information drives equilibrium values and efficient market pricing, short selling is an important part of the process. So if you decide that a stock is overvalued and you want to put your money on that belief, how do you do that? Well, first you have to be able to borrow the stock. And so you get that from the stock loan desk at your brokerage. You find out if you can borrow it and sell it short, then you sell 1,000 shares that you don't own. The idea being price falls later on, I'll buy that stock back, I will pay back the loan, which is in stock, not in dollars, and keep the difference. And so the short seller's profit or loss is the original selling price minus the repurchase price. And there may be some interest on your margin deposit and some commissions on the trades, but those are really kind of minor adjustments. So some of the rules of short selling, well, if you borrow a stock, then you must pay the dividends because when you're borrowing stock, very often it might be because it's in a margin account. If it's in a margin account, the brokerage agreement usually says that the brokerage house has the right to lend that stock out. But at the same time, even if they lend your stock out, your statement's still going to say, yeah, you've got 500 shares of Bank of America or whatever it is. And so if they're paying a dividend, those dividends have to be credited to your account. Well, if you're short those shares, your brokerage statement will say, well, you're minus 500. So it's pretty straightforward. They just multiply the quarterly dividend times your minus 500, and that's what you owe. The short seller also deposits margin, deposits some collateral for the trade. So if I call my broker and say, yeah, I want to borrow 1,000 shares of Microsoft and I want to sell it short, and they say, okay, that's fine. Well, I don't get the proceeds from the sale of the Microsoft. That stays in the account. And also, I have to make a margin deposit as assurance that if there are losses, that they are covered. So it's not a matter of your credit worthiness or anything. It's a matter that you make the required deposits either in cash or treasury bills or something like that. And then it's negotiated with the brokerage firm who's getting the interest on the proceeds of the short sale itself. So the idea, instead of buy low, sell high, we just reverse it with short selling. We'll sell high, and the idea being to buy low. Now let's talk about buying stock on margin. Margin purchases allow you to borrow a percentage of the purchase price of the stock. The broker keeps the stock as collateral, so again, your credit worthiness is not really anything that comes into play here. So there's an initial margin requirement. In the U.S. it's been 50% for as long as I can remember. And this doesn't mean a brokerage house has to loan you up to 50%. It means that's the maximum that they can loan you on the purchase of shares. This is set by the Federal Reserve Board in the United States. Now, you start out, you have to put up 50%. You can borrow 50% of the money. But what happens if the price of the stock goes down? Well, if the price of the stock goes down, you have some losses and your equity percentage goes down. And so there's a minimum equity percentage, and it's typically around 30%, I think. So to calculate that equity percentage, we just take the stock value minus the loan value, divide that by the stock value, and that's your equity percentage. So maybe a quick calculation here. If we buy a stock for $100 a share, and we can do these calculations in per share amounts because we're going to come out with a percentage anyway. So we buy a stock for $100 and we pay 50 of that and we borrow 50 of that. Well, now the stock goes down to 80. We've still got a loan of 50. So we own $30 worth of that $80 share. And then we put that over the new share price of 80. So we've got, what, 30 over 80, 3/8, 37.5%. So our margin, which was originally 50%, if the stock price falls to 80, has gone down to 37.5%. So we'd still be above a maintenance margin of 30%. And we can calculate what the price is at which we would get a margin call. Did I go too far? Nope, there we go. So let's calculate the return on a margin position here, and it's really your cash on cash return. We're going to calculate the percentage return on original equity. So our story here for the example, we're going to buy 1,000 shares of stock on margin at a price of $60 per share. Initial margin requirements 50%, margin loan rates 2%. Stock pays an annual dividend of 40 cents per share. There's a commission of 1 cent per share on the purchase and on the sale. At the end of 1 year, the investor sells the stock at $66. We need to calculate the investor's leverage ratio, or the leverage ratio of this investment, and the investor's return on the margin position. We'll first note stock is up 10%. Since the stock is up 10%, what kind of leverage do we have? Well, we'll see on the solution on the next slide. If we put up 50% of the money, our leverage is simply 1 over 0.5 equals 2. So that really means if this 1,000 shares, if we put up half of the money and the stock goes up 10%, our gains on our invested cash are about twice that, about 20%. So let's look at those calculations and follow through this example here. So here's our leverage ratio, 1 over the initial margin requirement. So we've got 2-to-1 leverage. So ignoring transaction costs and commissions, a return of 10% on the stock would result in a return of 20% on the equity investment. So from a per share standpoint, if we, what did we buy these shares at? 60, and they went to 66, so we made $6, but we only put up half of 60, we put up 30. It's not a very good 6 there. And so that's where we come up with our 20% return. Remember, leverage cuts both ways. Had these shares fallen to 54, we would have lost 20% of our equity, our initial margin deposit that we put up. So our investor's equity starts out at $30,000. The commission on the purchase is $10. So our total invested amount initially, $30,010. So we'll figure our gains relative to that. Okay. Our dividends, $400. Interest on the loan, we've got a 1-year holding period here, 2% on our $30,000 loan, right? 50% of the $60,000 purchase cost. For 1,000 shares, that's $60 a share. Our sales proceeds, $66,000, so we just need to put all these numbers together and account for our $10 on sales commission, not a big part of this transaction. So our remaining equity, we get $66,000 for the stock, we got $400 in dividends, we have to pay back our loan, we've got to pay that loan interest, and we got to pay our sale commission. So our net amount out of this is $35,790. So now we can calculate that, our ending value over our beginning value minus 1. You see we're quite close to the 20%. Just the difference, just the calculations for interest and commissions make it a little different than a 20% leveraged return. Oh, get the right slide here. So when do we get a margin call? Well, if our equity percent gets less than the required minimum or maintenance margin, then something's got to happen. We've got to either add cash to bring that equity in the account up, that equity percentage, or we can add paid for marginable securities, which gives us more margin flexibility, and 100% paid up marginable security added to the account would increase your percentage equity figured across the whole account, not figured individually on each security, but across the whole account. Now, here's the formula for it. 1 over the initial margin, so we could go 1 minus 0.5 over 1 minus 0.3 if 30% were the minimum maintenance margin here. Now, if you can't remember this formula, I'll tell you two ways to attack any problems that want you to figure out what price you'll get a margin call at. One, on the exam there's only 3 answer choices. Okay? So start with anyone. Start with A. Use the price. Figure out, well, if the stock fell to that price, what would be my margin percentage, just like we did on the last example. And once you look at that, if you test 2 of them and they aren't the right ones, you know it's the 3rd one. So 2 short calculations should do it for you. Now, another thing to do if you can't remember this formula here, I'll tell you where it really comes from, okay? We're going to buy a stock, and we're going to buy that stock at P0, okay? So let's say we buy a stock at $100. Well, our loan at 50% margin is going to be $50. And we know we're going to get a margin call if our equity equals 30%. So here's the only tricky part here is, well, you know, when our equity is 30%, how much of the stock value is the loan? Well, if our equity, cross my T, if the equity is 30%, the loan's got to be 70%. If you can make that leap, then you're okay, because we're going to go, well, our loan is $50. That doesn't change with the stock price. So when $50 equals 70% of the price, that's where we're going to get a margin call, or at least below that price we'll get a margin call. So all we have to do is solve for this, and that is 50 over 0.7, and we've got our price right there. Now that's essentially the same thing we've got going in the formula. So just remember, your loan doesn't change. If the minimum equity is 30%, then your loan has to be 70%. Set it up. $50 equals 70% of the price, or whatever your loan amount was originally. Do it on a per share basis. If they tell you there's 650 shares, don't let that throw you off. You can figure these on a per share basis. So let's go through an example. An investor buys a stock on margin at a price of 70. The initial margin requirement is 40. The maintenance margin requirement is 25. At what stock price will the investor receive a margin call? Well, I know you can apply the formula, but let's try it the way I described there and say, gee, price is 70, initial margin requirement is 40. Okay, so we got to put up 40%, so we're borrowing 60%. We borrow 60%, that's $42, and we go, well, $42, let's see, when our equity gets down to 25%, then our loan must be 75%, 0.75 of some price. Solve for that price, and you've got it. Well, let's do it with the formula here as well, and come up with $56. Does that work out? Yeah, that works out. So we can get there either way. So make sure you can do that calculation. And remember what happens. If the price gets below that, it doesn't mean your equity is zero. It means your equity is too low. So you'll get a margin call. You can satisfy that by putting cash or marginable securities into that account to get your equity percentage back up. If you don't, then they have to sell out your position, or at least enough of the position to bring your equity percentage up to the minimum level. Well, let's talk about some trades now and trading instructions. We're going to divide this into three headings here: execution instructions, validity instructions, and clearing instructions. Execution says how to trade, and primarily we're interested here in market orders and limit orders. Market order just says execute this buy order for however many shares immediately at the best available price. So that's the responsibility of the broker to get the best available price on that trade. A limit order, which we're going to look at in a little more detail, specifies that on a buy order, well, yes, I'll buy it, but I won't pay more than this. Or on a sell order, I'll sell it, but I won't accept less than this. The validity instructions on an order tells your broker when to trade. Now, this, for example, a limit order can be good till canceled. It can be fill it immediately or cancel it, sometimes called a fill or kill order, or we could just have a day order. If it's not executed during that trading day, then the order ceases to exist. It's just good for that one day. Stop orders execute if price reaches a specified level. And that comes from the stop-loss terminology, so we'll talk more about that. Clearing. The clearing instructions say how to settle the trade. Most trades are settled in a regular way settlement, but specific different settlement can be arranged. So you can have settlement instructions on those trades as well. So dealers buy at the bid, what they're bidding for the stock, and sells at the ask or the offer. So a dealer has a spread, we call that the bid-ask spread, and that represents the dealer's profit, or at least the dealer's desired profit. So of all the dealer bids and dealer asks, for example with the NASDAQ, which is not a stock exchange, it's an electronic communication system, all the dealers or market makers out there put in a bid and put in an ask. The computer stuff gives us the highest bid and the lowest ask, that's called the inside market, and that's what a retail broker, for example, would see on his screen as the bid and the ask. They aren't necessarily from the same dealer. They're the highest price a dealer is willing to pay for shares, and the lowest price any dealer is willing to sell shares at. So the lowest ask and the highest bid. Excuse me. The best bid and the best offer, we say, make the market. And a trade accepting the current bid or offer is said to take the market. Please learn this terminology. It's certainly not all that crucial in real life, but it's certainly testable material for the Level 1 exam. So, back to market and limit orders for a little more detail. Market orders, immediate execution, best available price. It's useful when you're trading based on information, and time is an important element of your trading strategy. But it certainly can execute at an unfavorable price, especially if your order is large compared to the amount of stock currently offered at the ask, or large relative to the average daily trading volume. Now, a limit order specifies the maximum price you're willing to pay. Okay? So if I put in a buy limit at 28, okay, that means, yeah, I'll buy, and you have to specify the number of shares clearly. That means I'll buy those shares as long as I can get them at less than 28, and you can get a partial fill on that. That is, if I want 1,000 shares with limit 28, and it's a day order, well, they might accumulate 600 shares for me at prices of 28 or less over the day, but not the other 400. You can put the order in with specifications of all or none. Either buy it all or forget about it. Selling at a limit price, well, that's going to be, if I put in a sell order at 26, it says, well, I'll sell it as long as I get 26 or better. And one of the things about limit orders, it avoids execution price uncertainty. The downside is that it might not get filled. So that's why the comment about information trading, if you think you're ahead of the game and you've better analyzed a stock and the coming earnings report, you want to get into that stock before the information comes out, or in some cases before others put the same importance and interpretation on the information that you do. So that might be a place for market orders. Some real seasoned, long-time portfolio managers will tell you maybe differently and say, well, why would you trade without a limit order? There's got to be some price that you don't want to pay more than when you're buying a position. So order might not be filled with a limit order. Now, stop loss orders, they also have a number attached to them, but they're not limit orders. A stop order, I'd like you to think of that as a trigger price. Okay? So if I put in a stop buy order, that price is going to be above the market. And if we put in a stop sell, it's going to be below the market. And so when the stock trades down to that price, it activates a market order to sell. Or when the stock trades up to that price, it activates a market order to buy. So let's say we've got a trader who owns a stock, it's trading at 35, and he says, well, I think I'm right about this stock, but I could be wrong, and if I'm wrong, I want to cut my losses and get the heck out. So what I'm going to do is I'm going to put in a stop order to sell at 31.50. Now, the stock's at 35, stops at 31.50, so if that stock falls 10%, I think is what we put in this example here, from 35 down to 31.50, down $3.50, that triggers a market sell order. Now, this doesn't guarantee you're going to get 31.50 for the stock. I mean, if some terrible news comes out and it falls like a rock, well, there you go. But that 31.50 triggers that market sell order. A trader who's short a stock, and these are sometimes called stop loss orders. That's where the terminology comes from, I believe. So if you're short a stock, then you're going to lose money if that stock price goes up. So by the same token, A trader who's short a stock at 35 might enter a stop buy order that says, well, if I'm wrong about this stock going down and it turns around and starts to go up, get me out. So 39 here is the trigger, $4 above the current price. So now a technician, a technical analyst who believes that a trade above 60 indicates a strong upward move, right? When we talk about technical analysis, sometimes we talk about support and resistance, and oh, if resistance is at 60, if that, or 59 and a half, and trading through 60 is going to tell this technician that, hey, I think this thing is going to run upward, then a technician who has no position in the stock could put in a stop buy order at 60 and say, well, if this stock trades at 60, I want to own it. If it doesn't trade that high, I don't want to own it. So that would be another use of a stop order. So let's take a look at a question here that I hope will sort out some of the difficulties that candidates sometimes have with this. A trader who owns a stock that is trading at 48 and would like to buy more of it if it increases in value to 52 should enter A, and take a second to look at this and determine clearly in your mind which answer you like the best. Well, the mistake often made is to choose A. It's actually C, a stop buy order at 52. What I wanted to highlight through this problem here is that if we put a market buy order at 52, well, there's no 52 on a market buy order, so that, market buy order doesn't have a price on it. A limit buy order at 52, what happens if we enter that order? Well, the stock's currently at 48, and we're saying, I'll buy it at 52 or better. That would execute immediately. You'd end up buying more shares at 48 right now. It's the stop buy order that says, well, this order isn't a buy order until that stock trades up to 52 and hits that trigger. So a limit buy order and a market buy order would both execute immediately. And that's not what we want. We want to buy more shares if this thing starts to go up. Okay, we mentioned before primary and secondary markets, sales of new issues of stocks and bonds, IPOs or seasoned offerings we call it. IPO is initial public offering. That's the first time these securities have been sold to the public. A seasoned offering or a secondary offering refers to selling more shares to the public of a security that's already trading. So don't get a secondary or seasoned offering confused with secondary capital markets. That's where we trade used securities. Securities trade after their initial offerings. And one thing you should understand is how important secondary markets are because they provide liquidity, they provide information about value on an ongoing basis. So the primary markets work as well as they do because of subsequent trading in the secondary capital markets. Now, in this primary market, we can have different types of offerings. The first one we want to describe here is an underwritten offer. And when we say underwritten, the investment bank guarantees the security sale. They, in fact, buy the whole issue. Now, they don't have to pay for it up front, but they buy it in the sense that they're going to sell it to the public at this predetermined offer price. And the basics of it is that the investment bank, in this case with an underwritten offering, is taking on the risk of the sale. Now, it's sometimes not that much risk because they've already solicited indications of interest. They've gone out, they've got people signed up that are going to buy this new issue out there, but there's still a time period between the pricing of the offer and the actual transactions in which they are accepting some risk. Now, if they don't want that risk, they can do a best efforts offering, and in this case, the investment banker is acting as a broker and saying, okay, there's 2 million shares going to be issued here, and we'll sell as many as we can, but we don't guarantee to sell them all. And sometimes there's a threshold level with the best efforts offering that, well, okay, if the brokerage, the investment bank, or the investment banker's syndicate doesn't sell this much, then the offering's called off. It's not worth it to us. In a private placement, we're selling directly to qualified investors. So these are not securities that are registered for public trading. A shelf registration refers to registering securities for an offering, but then selling them over time. Okay? So this can be done with bond offerings. It can be done with stock offerings, but it's not equity offerings, but it's not done as often. Dividend reinvestment plan. In this case, the firm issues new shares to shareholders who reinvest dividends. Most dividend-paying stocks have some sort of dividend reinvestment plan where the shareholders can elect to invest in their dividends in new shares held in account, held in fractional shares, and things like this. A rights offering, we say here, sell new shares to current shareholders. If we're going to offer a secondary offering, we've got a stock that's already trading, we're going to issue some new shares, these rights are granted to existing shareholders. It will say, well, you have the right, for each share you own, you have the right to buy X shares, and that could be 0.1 shares or 1 share or whatever, X shares at such and such a price. And so these rights have offering. It gives existing shareholders the opportunity to buy new shares to keep their percentage ownership of the company the same. Let's see, where's my little mouse here? Here we go. Market structures. Again, some terms that you need to know. A quote-driven market is what we refer to when investors trade with dealers. So the NASDAQ market with its market makers and its bids and asks, the inside market, bid and ask, that's all driven by their quotes, right? Their bids and their asks. An order-driven market, like the New York Stock Exchange, rules are used to match buyers and sellers. So it's the arrival of buy orders and sell orders, whether those are stop orders or market orders or limit orders, that are driving the trading and the pricing of the market. In a brokered market, brokers find a counterparty for a trade. Call versus continuous markets, we already touched on this. Securities trade at specific times in call markets. And this is in less developed markets where there's not a lot of activity, there's not a lot of liquidity, not a lot of trading, in order to get some market clearing prices. Otherwise, you'd have a situation where every time a buy order comes in, the price jumps up. Every time a sell order comes in, the price goes way down. Well, this is not an efficiently operating market at that point. So when there's a lack of liquidity and a lack of activity in new, less developed markets, we'll accumulate these buy and sell orders over a period of time and then clear them all at once. Continuous markets, as we said before, trades occur anytime the market is open, and the price can be set by auction or by dealer bid-ask quotes, depending on what type of market we're looking at. So what are the characteristics of a well-functioning financial system? Well, it should be complete. Assets and contracts are available that allow you to move risks and take whatever positions it is that you feel you need to in the market or are advantageous in the market. They should be operationally efficient. This could be evidenced by low transaction costs. Liquid markets be evidenced by low bid-ask spreads. A well-functioning financial system should allow for informationally efficient market prices, that is, prices that reflect fundamental intrinsic value. And as new information arrives, informational efficiency says that prices should adjust without bias, maybe not correctly, but with no predictable bias, to a new level to reflect the new information about the future cash flows from the security. Financial intermediaries facilitate transactions. So whether that's brokers or banks or savings and loans or insurance companies or swaps dealers, whatever it is, there's financial intermediaries out there to facilitate transactions. Now, markets are regulated. What are the objectives of market regulation? Well, I'll try and do this with a straight face. One is to protect unsophisticated investors. The Securities Exchange Commission in the U.S., Securities Acts in 1930, 1931, all that came what? It came after the great crash of 1929. Well, maybe unsophisticated investors are protected, but certainly not protected to any great degree. We've seen many big moves in the market when, I guess, sophisticated investors got pretty beat up as well. Require minimum standards of competency, that is for brokers, for supervisors of brokers, and also restrictions on exchange and exchange members. Prevent trading on inside information. The usual argument for this is that if investors perceive that insiders have an advantage on the trades, then they won't trade. And this will lead to less participation, less activity, less liquidity, and higher costs of funds across the board. Require some common financial reporting standards. Of course, we looked at that in our financial reporting and analysis, how the securities regulators and the financial accounting standards boards set up their rules and requirements for not only how often, but how financial transactions are reported, and require minimum levels of capital, especially for broker-dealers and banks. Well, our last slide here is a problem here. An investor who purchases 400 shares of stock at 42 and posts initial margin of 40% when the maintenance margin requirement is 30% will get a margin call if the stock price falls below. So let's just see if you can do that in about 30 seconds here. Well, it goes real fast if you remember the formula. Here's the formula: 1 minus the initial margin requirement over 1 minus the maintenance margin requirement. So we come up with 36. Now, how could we figure out? Remember, I said if you have some you can't remember this formula, you've got to check it. Let's check backwards and see what this margin is if the price falls to 36. So if the price falls to 36, how much is our loan? Well, let's see. We posted initial margin of 40%, so we borrowed 60% of 42. Unfortunately, that's not an easy number I can do in my head, but that's the portion of the stock we own, the stock value minus the loan. Then we divide that by 36, and that should come up to our 30%. So we could identify that even if you forget that formula. But the formula is not that bad. Put initial on top of maintenance. It's okay. I comes before M in the alphabet. Shouldn't be too hard to remember. So 1 minus the initial over 1 minus the maintenance times 42. Don't worry about the 400 shares. Pick 36. Save yourself some time on these easy calculations so you can spend that time wrestling with ethics questions that you can't figure out for the life of you.